Should I follow the crowd? That is the topic of today's video, and I'm gonna start today's video by quoting one of the greatest investors of all time, Warren Buffett. He has this quote, "Be fearful when others are greedy, and be greedy when others are fearful." This paid off for him big time when he dropped $5 billion into Bank of America, coming out of the Great Recession at about $10 a share in, I think it was late 2018 or late 2018. It hit a high of $30, right around $33 a share. A 300% return on $5 billion. Well, that's not too bad. How does that saying apply to day traders? That's what we're gonna be talking about today. So as a day trader, what I feel like I'm doing most of the time, and I'd love for you guys to comment below what your thoughts are and what you do, I feel like I buy high and sell higher. So that saying, buy low, sell high, if you've ever seen like the vanity plate on a Ferrari, buy low, sell high, you know, that doesn't really apply to active day trading. Certainly it can apply to investing. It's definitely an investing strategy to buy undervalued stocks, no doubt about it. But as a day trader, I don't feel like that really works. And it's because in the context of just one day, and even within just a few hours, I don't feel like there's usually enough range to really truly buy something very low unless I'm doing reversal trading on large cap stocks, which I've never found to be particularly rewarding or give me really big wins, certainly not home runs. As a trader, what I'm generally doing is buying high and selling higher. And that means I'm kind of following the crowd because I'm buying a stock that's already been bought up quite a bit. A stock that might be gapping up 10 or 15%, meaning it's up 10 or 15% versus yesterday's close, and is maybe up another 5 or 10% this morning in the last half hour. So I'm buying a stock up 25, 30%. That seems crazy, right? Well, what about when I buy that stock and then it goes up another 30, 40%? Now it's up 70% on the day. All right, this thing is really taking off. Now, am I a dummy if I buy it when it's up 70%? The stock's up 70%, that's kind of crazy. Well, what if it then runs another 50% and is up 120, 130, 140%? So who's the dummy now? The guy who bought it when it was up 70%, or the guy who sat on the sidelines and just watched it run without them? That's the struggle. Here's my thought on crowd mentality. As a day trader, there are usually only a small handful of stocks that are really moving each day. And so we use these tools, these scanners, it's kind of like radar to help us find what's moving. And the scanners are constantly running, and then boop, 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 they start to lock in on something. Something is moving. All right, so we all go to that. And all traders go to it. So, we use these same tools, similar tools at least. They all serve the same function of trying to find stocks that are moving. I'll put a link below in the description for the scanners that I'm using so you guys can check them out. But when we find something moving, we all just lock right onto it because we want a piece of the action. So the crowd all rushes to this one stock that's moving. Now, as a result of the crowd rushing to the stock, it starts to move, and then people jump into it, which creates more movement, which attracts more traders, which creates more movement, and then all of a sudden you have this cycle. That's what we call the parabolic cycle, where stocks all of a sudden go up, 100, 200, 300, 400%. And we've seen it happen. Some of you guys remember some of the biggest movers of all time, DRYS, LFIN. These are some crazy stocks. Comment below if you traded any of those and made money, or maybe you lost money. I personally didn't trade DRYS on the day of the big move. I think I traded it the day before. And LFIN, I can't remember, but that was nuts. Just totally crazy. In any case, my problem is that when I see these stocks that are up $3, or they're at 3 and then they're up to 5 and they're 6, so now it's up 100%. And then it's up to $9, it's up 200%. It's going higher and higher, and you feel like, I can't buy a stock at $9 that was just at $4 or $3. That's crazy. Next thing you know, it's at 15. Dang it, 16, 17, 18, 19, 20, 22, 24. All right, forget about it. I'm just jumping in. That's FOMO, fear of missing out. And then you just jump in, you mark it in a crazy spot. This is sort of my approach. since I know that there's usually only a couple of stocks each day that are really strong, I want to focus on them. And that means that I am ultimately trading with the crowd, because all traders, active traders, are honing in on those 2 or 3 stocks each day that have volatility and volume. All right, so we're going to trade pretty much the same stocks. But what I want to do is I want to capitalize on FOMO and never fall victim to it. So what I mean by that is when I see a stock starting to take off and it's moving higher, and let's look on my chart here, RKDA. So RKDA is a stock that literally was at $2 and then the next day squeezed up to a high of $4.97. The stock's up over 100% on 56 million shares of volume. 56 million shares, that's a ton of volume. So the crowd was focusing on RKDA. The second day, the stock that's already up 100% goes up to $7.34. Now it's up over 200%, closing in on 300%. Within a couple more days, it hits a high of over $10 a share. That's 400%. So this stock clearly was making big moves, big volume, big volatility, huge opportunity. And absolutely, you would have been trading with the crowd if you were trading it. How do you capitalize on the opportunity without falling victim to fear of missing out and buying it too high? So the question that I always ask myself when I'm seeing stocks that are moving quickly, I ask myself, what is the potential that the stock has and how much am I risking? Now the risk question is a really important one, because I get this all the time. Students will sometimes say, Ross, you bought $50,000 worth of stock. Let's say I buy 10,000 shares of a $5 stock. That's a $50,000 position. And that's a pretty big position, even for me, no doubt about it. But I'm not actually risking $50,000, right? So let's think about this. Let's look at the profit trifecta. So the profit trifecta is a way to understand the comparison between profit-loss ratio and accuracy. So what I look at are the 3 core components of profitability. The first one, consistency. And the question here is, in the last 6 weeks, how many of those weeks were you profitable? And so if you're profitable 4 out of the last 6 weeks, you're doing pretty well. All right, next one down is accuracy. Out of 100 trades, how many of them were winners? If you're right 70% of the time, 70 winners out of 100 trades, you're doing pretty darn well. And now the third is the profit to loss ratio. So if I put $50,000 into a trade, I'm not risking $50,000 because I now own an asset. That stock has value. And so in fact, what I'm really risking is the difference between my entry price and how far I'm going to let it go down before I sell it for a loss. So if I'm in it with $50,000 when it's worth only $49,000, I'm probably going to sell for a loss and take back my 49 grand, which means I've lost $1,000. And so I look at that as actually just risking $1,000. And then if I'm up to $52,000 in total value, I would have sold it for $2,000 profit. So the goal here with a good profit-loss ratio is to risk $1 to make $2, to risk $1,000 to make $2,000. And so when I see these stocks ripping up, moving higher, I'm asking myself, what's the most that I'd be risking if I bought it right here? And so let's say I'm going to evaluate the current pattern, the bull flag, the flat top breakout, the micro pullback, and tell myself, okay, my max loss on this right now is $1,000. Okay, so that's my risk, that's my loss. What's the potential of profit? And if I look at a stock like RKDA and it's squeezing up from $5 yesterday and it's at $6, and I know if it breaks 6, the next psychological resistance point, what do you think it's going to be? 6, 650, 7, 750, 8, 850, 9, 950, 10, 1050, 11. These stocks often start moving in 50-cent increments. They start to run into a little bit of resistance at the $0.50 and the whole dollar. So once it breaks through the $0.50, I'm looking, of course, for my first entry point. Next profit target is the next half or whole dollar, whichever one is closer. So if I'm risking maybe $1,000, then my profit target is up to the next half or whole dollar. And if that's at least $2,000, at least 2 to 1, then I'm going to take the trade, even if the stock is extended. But what I won't do is if I just see it ripping up higher and higher and higher and higher, I will not just impulsively press the buy button because I just see it going higher and I'm just like, I'm missing out, so I'm just gonna jump in. Whenever I do that, it means I'm buying sort of at the top of this extension, and although it may continue a little further, my downside risk is all the way back to where that first pattern began to break out. So whether it's a 1 minute pattern or a 5 minute pattern, I need to have what I would consider to be a low risk entry, which would be buying maybe the little dip off of a pattern. So again, if you're a little lost here on these pullbacks, the terminology, check the links below, register to one of my webinars where I really break this down in more detail. And just for right now, know that I think there's a very valid strategy as a day trader in buying something that is already high with the goal of selling it higher. Things that you, of course, have to be mindful of: the risk of a T12 halt. T12 halts are when stocks are halted pending a review by the exchange. So the actual exchange says, well, hold up, this stock's up 800%. There's no news. What's going on? They'll halt trading in the stock. They'll go to the company and say, hey, what's going on with your share price? The company will often say, there's no material news that we're aware of that warrants this type of move, so we don't know. And then when the stock resumes, it often opens a lot lower because part of the reason it was moving up was speculation. Maybe someone knows something. Maybe something is happening. There's no news, but maybe there will be. So then when the company says, no, there's actually no news, the stock opens a lot lower, and that's where you can take a much bigger loss than you were anticipating. So the way I avoid T12 halts is I really try to be very careful trading a stock that's up more than 200% that has no news. Now, if the stock has news, they've got FDA clinical trial results, they've got a new contract, they've got great earnings, then that's the catalyst. That's the reason it's moving higher, and I feel totally comfortable being in the trade. Unless, I guess, it gets to the point of being up 1,000% or something that's really, really getting crazy. And then by that time, the stock is obviously well over $20, and it starts to get into the place where the dollar amount in the trade and the price of the stock is outside my wheelhouse. You know, I focus on $3 to $8 as being where I really do the best. Anything above $1 and below 10 is good. When it starts to get into the teens, into the 20s, that's where I start to struggle. Now, when you have a stock like LFIN that goes from $30 to 40, 50, 60, 70, 80, 90, 100, you're thinking, oh my God, this is insane. It's got to have resistance at 100. Pulls back for a second. All right, that's what I thought. Then 110, 120, 130, 140, you got to be kidding me. Literally went up to $140 a share two or 3 days before it was at $8. So that was the craziest one of all time. And on that one, I had to sit on the sidelines because I just felt like at that point it was FOMO to be trading it that high, because even the pullbacks, they were so extended. The risk to get in, the pullbacks were so big and so dramatic, it just didn't feel safe. The question will continue to be, yes, I'm happy to trade with the crowd. I'm happy to trade the stock that's moving, but can I manage my risk? And if I can manage my risk and I'm not concerned about a T12 halt, then I'm going to jump in. Because each day when we have those one or two strong stocks, it's kind of a feeding frenzy. That's what it's like, sharks in the ocean. And when there's a fresh piece of meat, a fresh stock, everyone goes for it and gets as much as they can on it, and then it kind of is gone. And on that same note, one of the things that's interesting is, let's just say, for instance, that there's a really fat seal that drops in the water. It's a huge feeding frenzy. All the sharks are happy. So you get this huge move in one stock. Everyone's excited. And then, there's another small opportunity. There's like a smaller seal. That one's not too exciting, but, people get a little piece of it. And then, there's a burr that drops in the water. Oh, okay, I guess I'll go for that. There's a little something. It's not a lot. And then next thing you know, there's like a lobster pot dropping, and everyone goes for it. Ow, everyone gets burned. Everyone gets hurt. That was terrible. I'm not doing that again. The next thing it drops in the water, everyone just sits there. No, I'm not going to be fooled. And then a seal comes in the water, and you're thinking, I don't know, I'm not sure. Wait, someone else is eating? Okay, I'm going for it. and it starts the new round of momentum. And so that's kind of that ebb and flow in the market where we have these huge opportunities that kind of come out of nowhere. They might surprise us at first, and then we get into a real feeding frenzy where we feel really confident. The winners, they're all kind of crunched together, back-to-back big winners. And then it kind of gets to the backside of that mentality where you're seeing stocks failing a lot sooner, and stocks are popping up but getting rejected, and it's not working, and you're starting to get burned. You're starting to get a little hesitant, a little cautious. You slow down, and then that might mean you miss the first one that starts to pop back up, but you see it's working, and then you start to take a little bite, a little taste, and then you're back into it, and then we start the next round of momentum. So what I always say is the market, it's not seasonal. It's not about necessarily time of the year or the day of the week or anything like that. It's cyclical. We have hot cycles and we have cold cycles, the ebb and the flow. And what you really, as a good trader, need to be able to master is the ability to ease on the throttle when it starts to heat up, increase share size, be more aggressive, try to really capitalize on that hot streak, and then ease off the throttle when it starts to slow down, so you don't start giving back profit. And when it's slow, just kind of tread water, go easy until things start to pick up. Because the last thing you want to do when the market is slow is waste your energy and essentially take unnecessary losses jumping into things that aren't really working. Because that's the time when there isn't a lot of crowd mentality. Because what you notice is a lot of people are just sitting on the sidelines. And the ones that are able to do that comfortably, of course, are the ones who did really well during the last hot streak. And they're like, well, I've got my cushion, so I can just sit tight. And then, of course, the ones who feel like they really need to pay the bills, they're the ones out there fighting it out, trying to find something, but there's nothing there. They incur unnecessary losses. And then by the time the next hot streak comes around, those wins are just getting them out of the hole. And that creates this sort of negative cycle. So it's really interesting, this kind of mentality of a trader. I'd really encourage you to try to, if you're not there yet, at least adopt the mentality of a profitable trader. That kind of just thought that I'm successful, I've got a cushion. If the crowd is kind of on the sidelines, if we're not seeing a lot of opportunity, I'm gonna step back, I'm gonna go slow, I'm gonna wait until I see things pick up. That's the game plan. It's been working really well for me. So as always, questions, comments, leave them below, and I'll see you guys back in the chat room.
Oh hey, I didn't see you there. Well, I was just working on the dream board for my next home run trade. Hopefully it comes soon. Until then, make sure you subscribe to get email alerts anytime I go live or upload new videos. Until then, happy surfing.